Hello, and welcome to Virtual Investor Conferences. My name is John Viglotti, and on behalf of OTC Markets, we're very pleased you joined us for the Oil and Gas Conference. Our first presentation of the day is from Valeura Energy. Please note you can submit questions for the presenter in the box to the left of the slides, and you can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found in the conference platform. At this point, I'm very pleased to welcome Sean Guest. He's the President and Chief Executive Officer of Valeura Energy, Inc., which trades in the OTCQX under the symbol VLERF and on the TSX under the symbol VLE. Welcome back, Sean.
Thank you very much, John. It's good to be back here presenting to everyone. So, Valeura Energy. It's been of a changed story over the past few years. Initially, we were a Turkish company producing gas there, but we had a couple of deals that we did in 22 that has transitioned the company over to Thailand, and I'll just take you through that story now. So first off, for the disclaimers, I'll leave you to actually review those on the website where you can find the corporate presentation there and look through those in detail. But looking at the company, as I mentioned, we did a transition back during the time of COVID in 2021, and we did two major highly accretive deals. We acquired the interests of two companies in the Gulf of Thailand. Now, one of them was from Chris Energy, a company that was in receivership at the time, and we bought a suspended oil field from them that was not in production. And the other one, which is more significant, was we bought the producing oil assets of Mubadala Energy, the sovereign wealth fund of Abu Dhabi, and we bought just about 20,000 barrels a day of oil production for about $10 million. And really, those two deals is what's transitioned the company from what was at the time 30 million in cash and some small assets in Turkey to now the second largest oil producer in Thailand. We've increased our production to about 26,000 barrels a day. And really, there's two aspects. Of first, having done the deals, the second part was really then what have we delivered since that time? Well, first, it was just over a year and a half ago, we closed the last deal. So in Q1 23, very quickly, we were able to pay off the debt that we took on to do the deals and have increased our cash position over that time period from about $10 million US to, at the end of last quarter, we had 156 million. Operationally, we've increased production 29%, restarted that field that was suspended, and we've even developed a new oil field in that time. But the important thing to note, and really what everyone's looking at, is the reserve replacement. How much reserves did we replace? Because one of the feelings in the market was, well, there's a short reserve life index on these fields, and therefore, that's why we were able to get it so cheap. But our knowledge of having worked the Gulf of Thailand before was that you can keep adding the reserves there. And we demonstrated this in our first year in 2023, where we did over a 200% reserve replacement ratio and also extended the life of all four of the fields we're dealing with. And another element we were focused on since acquiring was we've reduced the abandonment cost by about 30%. And we have more engineering studies going on that this year where we hope to see further reductions there. But really what we're talking about now is a strong cash flowing company that's leveraged to Brent oil pricing. Another key point to note is that when we went after these two deals in 2021, one of the key reasons we wanted both was Mubadala's assets were 20,000 barrels a day, highly cash flowing. But the Chris Energy assets had about 400 million US dollars in tax losses. Now, just last week, we announced we've actually restructured, brought these companies together so that now 3 of the 4 fields are able to access those tax losses. And that's really going to accelerate about 200 million in cash flow for us over the next few years. Right? And with that, looking at the analyst report, we really expect to deliver sufficient cash by the end of 25 to pretty well come to our full enterprise value that we currently have. And with this strong cash flow, the other announcement we made last week is starting some return of capital to shareholders, and the company has actually implemented a share buyback program through an NCIB on the TSX. And then the last point we'd like to make is just we were able to do these highly accretive deals we're very experienced in the region, and we see more deals like this to really look to grow the company much further beyond that. And now we have both the cash and the cash flow to deliver on that. So just before I move off this slide, I just want a couple points on the oil and gas industry in Thailand, because I know speaking to people, whether in Canada or the US, Thailand is a long way away and generally more associated with holidays. But the Gulf of Thailand has had decades of oil and gas production. This was a heartland for Unocal, and in fact, one of the reasons that Chevron acquired the assets there. So really the main producers in the Gulf of Thailand are the national oil company PTTEP and Chevron in that area. But the other advantage it brings to us is this is an area there where you have staff who've been highly experienced, local staff. You've actually got contractors, you've got the main contractors all working in the Gulf of Thailand. So it's easy to draw on services, and it's actually quite a low-cost regime to operate offshore in. Okay, just looking at the share price over the past couple of years. And the thing we like to point out to people is that, yes, we got a really nice bump when we did the Mubadala deal to acquire that from about 50 cents to $2. But a lot of the increase since that time has really been on delivering on the assets and delivering on the reserve increases. And that's what's continued to drive the price up as we show people that these assets have much more future than it looked at initially. We've also been very rewarded. We were the Upstream Company of the Year in Asia Pacific, the Executive of the Year. Recently, the Globe and Mail just published the top 500 growing companies in Canada, and we were number 8. And also just to throw that in, is a month ago, we were just awarded by the Minister of Natural Resources and Environment in Thailand. We received actually 3 environmental awards for our operations. PTTEP received 5. But other than that, we were the only oil and gas companies to receive those. Now, a bit about the shareholders is Baillie Gifford has been a long shareholder within us, large fund out of Scotland. But when we did the deal and actually came into Thailand, bought the Mubadala assets, Thorson Thai Agency is actually a public company traded on the Bangkok Stock Exchange, but it's an investment vehicle for one of the richest families in Thailand. And they saw the opportunity of what we were doing in Thailand, liked it, and they actually bought that 12.5% on the open market there. Another point I'll just note is we actually do have extremely high liquidity relative to our peers as well. Okay, a quick run through on the 4 assets that we bought. The top 3 assets, Manora Field, Jasmine, and Nong Yao, we acquired from Mubadala. The lower one, Wassana, was the one that we got that was in suspension. We operate everything, and you can see have very high working interest across these blocks. So we have really control of the operations. While Manora is our smallest field, what's interesting about it is in 21, when we were bidding to buy these assets, that field was due to be abandoned in 22. We've had better production on it. We drilled some more wells there. And we've actually extended that out in our last reserve report from 22 to 27. And in fact, the rig has just moved onto Manora now for a new 5-well drilling campaign. So it's really a poster child here of what you can do in the Gulf of Thailand. If fields that are due to be abandoned with more infill drilling, working the assets more, you can push this out. And I expect this field to still be producing in 2030. Jasmine has been one of the largest fields contributing to the production, and we just finished a 5-well drilling program there that has upped production quite significantly. And another point we made there is we have identified an exploration prospect that we plan to go to in 2025 that can add quite significant value. But really, Manora and Jasmine, they are mid to late life fields, and really the strategy there is to just keep pushing out the production and extend them. Nong Yao was our growth asset this year. We did a new field development there called Nong Yao C that came online in August and increased production there about 60%. Additionally, earlier this year, we had an oil discovery at another area, Nong Yao D, and we're currently going through appraisal work on that to look at further drilling there to see if that really will be the next potential drilling location. And finally then Wassana, the other field we restarted, did a 5-well campaign. You can see with the work that we're doing there, we've significantly identified more reserves, and we're going through a redevelopment plan on that now. But I'll speak a little bit more on Wassana in a couple of minutes. Okay, I'm not going to go into real details on all the text on this slide, but the important thing we really want to emphasize is that at Valeura, we still believe in value through growth. And that's really what our shareholders have received over the past couple of years. With the asset base we have now, we see that we can invest there for the further organic growth, and that's what we've done recently, increasing production and reserves. We also, as I mentioned, we see the ability to do actually quite significant M&A in the region to grow the company further. But the center point really pushing on operational excellence. And while we've shown we can do good deals, it's extremely important that you still have top quality operations to make sure that the assets deliver the cash in the future and the value of the company. It's just important that you don't end up stubbing your toe on any of these, because then that reputational loss can really feed right through to your value. So we have an excellent CEO with experience in Shell. My experience, a lot of my career is with Shell and Woodside, and we bring a lot of those processes to the company. So while we're trying to be quite nimble, we still have good, solid processes to operate these assets. So just re-emphasizing some of the key points of what we've done in the past 18 months. Production up 38% in the past year, and that was largely with bringing on that new field at Nong Yao, restarting the Wassana field and getting that successful horizontal program there. There's other small works going on there. Importantly, reserves at the end of last year up 219%, and that was across all of the fields, and we extended the life of all of those fields. Now, the bigger point we make there is that we are looking at redeveloping the Wassana field, having identified much more oil there. We see the ability for that to even add further oil reserves as we go into next year and beyond. We did drill 3 successful exploration wells this year. And again, while we don't really need to bring those on right away, it was really demonstrating to the market that there's more oil that we can find out there. So we've had a good year in the reserves, and we're really looking forward to year-end 24 because of the drilling we've done this year, the new developments. We see a lot more potential for further increases. On the balance sheet, we talked about the debt was repaid quickly. We've now got $156 million in cash, and with that corporate restructuring approved, we see that that's going to accelerate cash flows significantly. And then on our guidance for 24, even though we had a delay in the bring Nong Yao C on, we had to shut down the Wassana field for some review of the integrity there for a month. We are going to deliver right on the mid case of our production and our OPEX, and on CAPEX, we're going to come in right at the bottom end. So it's been just 18 months, and it's just, we're very pleased with what the team's been able to accomplish. So just speaking a bit more about Wassana, and the reason for this is this field, when we took it over, our first reserve report was 4.7 million barrels. Last year, we had this at 12.9 million barrels. And with the appraisal work we did, what we've identified is that the production facility that was originally installed there is too small to really recover the amount of oil that's there. The team is going through a new development plan for a new facility. And then the main part of the field we see is going to extend the production out, not till 27 or 28, but well into the 2030s. To the north is where we had the new exploration discoveries, and those actually proved up enough oil to the north for another development to tie back. And now we see there's discovered oil to the south, and we look to appraise that as further development. So it's really another case here. It wasn't at this field about just extending it for a couple of years, but we see the ability with the new facility, increased production here, and that reserves are going to continue to increase on this, and production is going to go well out into the 2030s. So the issue that we've had to kind of address is the reserve replacement ratio. And what people don't realize is, well, it looks like we have a very short reserve life. That tends to be very typical in the Gulf of Thailand. And that's because it's a very broken up geology with lots of different layers and fault blocks. And what you get is that You've drilled a few wells, you've now got a facility installed and are producing from it, but the next fault block over is not in your reserves because it's not penetrated. Under the reserve auditing rules, you must have penetrated the oil before it can actually be included in reserves. So what we know though is it's extremely low risk, and what the company has been doing is just step out drilling into these neighboring fault blocks. But really what it's kind of equivalent to is you're doing exploration with a 95% success ratio. At the end of the exploration well, it's on production, and at the end of the year, it's in your reserves. And that's really what you're looking at here, is this case of you just do sufficient drilling that you're actually bringing on these new fault blocks, bringing on these new layers, and you're able to continue to fill up the reserves every year. And the actual case shown on the right there from the Jasmine field, where you're looking at one well on production in 2006, that then gets drilled into a new fault block in 2013, and then that was then updated in 2022. But this is something that's very typical in the Gulf of Thailand. And in fact, when you look at the data that's available in the Gulf of Thailand, over the past 3 years, they've averaged 122% reserve replacement ratio, even without bringing on any new fields. It's just continuing to drill around the fields that are there. And kind of making that point explicitly when we look back at the reserves for these 4 fields. And again, we have to show the 1P here. Normally we would show the 2P or probable, but the 1P reserves are what's available on the government's website. And you can see in 2018, you had 20 million barrels. Our first reserve reported in 22, you're pretty well at the same number. And then with the work that we put in last year, we were actually able to increase that almost 50%, right? And then overall on our proved plus probable, we replaced the reserves we produced by over 200%. And again, as I noted, the team are doing a lot of work this year, and we expect another good report coming up in mid-February. So just going over to the financials now. Now, Thailand is a tax royalty system. The fiscal terms, it's a simple royalty to the government, and then it's a 50% petroleum income tax, or what we refer to as PITA. What we like about working over in Southeast Asia, and particularly in Thailand, is once you've signed this contract, those fiscal terms are locked in. So the government may change the fiscal terms for new awards in the future, but the terms remain fixed for you for the life of your assets, and there's no history of them having changed them there. So if oil prices go high, they don't change the royalty, they don't increase the tax or put in a special super tax. The terms that we have are fiscally stable with the government. And we like that from an investment point of view, because when you're investing, your uncertainty is oil price. It's not the mood of the government, whether oil is positive or negative. The government's very supportive of oil production here. And this is just looking back at the last 12 months. You can see there we were producing on average about 22,000 barrels a day, but realized price of 84. It's 623 million in revenue. And when you kind of work that down through, and with the taxes that we paid, we came out to a 220 million of adjusted cash flow for the past 12 months. But when you look at that as a net back on the operating margins, extremely good net back of about $44 a barrel. And what we see is that it's actually quite resilient to oil prices in the area. So we're very strong position here. Now, the next one I just want to really step on is show, we talked about the corporate restructuring, where now the fields that are under what are called Thai 3 fiscal terms are Nong Yao, Manora, and Wasana. And those are now, they've all been grouped into a single entity, which originally only held the Wasana field. So this creates a lot of synergies in how you operate, but also you're only doing one tax filing for the 3 companies. You can see you can then utilize costs in one asset against another. And this is the case here where the Wasana company had about 400 million in tax losses, and we're now able to apply those across our other fields of Nong Yao and Manora. And this is particularly important with Nong Yao, as it's really almost half of our production now, and is also our most profitable field. But what you're looking at is the top on the LTM actual. That was the slide data from previously. And the lower one just shows that if you weren't paying the taxes there, what is the actual boost in income that you get? And as we see there, you're actually looking at, instead of a 94 million free cash flow after your capex, you're looking at 152 million in free cash flow. So if there's about 200 million in value to utilize there, we see at the current pricing you'd use that over the next 3 or 4 years. But that's a real boost to our cash flow that we've got there, and very significant move for the company. Now, with that strong cash flow, it then comes down to, okay, the capital allocation strategy. As we noted, we're really looking at growth, but our first thing with the capital is obviously to look at enough capex injection that we're really looking to maintain these 4 assets we have, as close to 25,000 barrels as we can, but between 20 to 25,000, and that's out till 2030. It's not that there's only a couple more years of life here. We see with the capital investment, we can continue to push this out. M&A is our next focus. I'll talk about that a bit on the next slide, but looking at other deals that can actually grow the company significantly, but at the same time, they have to be accretive. And then the final element we talked about is, with the amount of cash flow that we're currently seeing, we have the opportunity to still do very significant deals, but we can also look at some return of capital to shareholders. And in that way, we've put in place a share buyback program at this point in time. And that'll be valid for the next year. It's approved for 1 year by the TSX. And you can buy about 10% of your free float, which for us would be about 7.3 million shares at that time. We did look at different mechanisms, but really we saw the most efficient one, and what seemed to be the market was looking for was more in a share buyback rather than a regular dividend. At our size of company, we don't see that's appropriate, but as we look to grow further, well, we can see that a dividend could be coming in the future. So just a slide on M&A. And again, we still see more opportunities like we did. Now, I don't expect we're going to get another deal of getting 20,000 barrels a day of production for $10 million. But there's other deals that are possible out there that are quite significant that have a very similar character. We've seen recently a number of the majors have been retreating from the Southeast Asian region. A lot of that due just to the materiality of the assets they have. And we've really now positioned ourselves as one of the leading independents and one of the most aggressive independents in the region, that we see there are more deals that we can do in the area. Our key focus is on Thailand because we have a full team that's operating there. We know the region. We have very good relationships there. But that would be our primary focus, but we are looking at other areas like Indonesia, Malaysia, Vietnam, for example. What we really have that makes it work out well competitively is that actually there's only about 3 companies that really are our size in the region that are looking at acquiring assets. Hibiscus, based out in the KL Stock Exchange, Jadestone, who are in London on the AIM, and ourselves. So if you're looking at companies that 15 to 30,000 barrels a day, there's really a very limited suite. And with our cash position, it opens up a lot of opportunities around the region. Just a couple of points, on sustainability, and that we did, having taken over these assets a year ago, we've now put out our first sustainability report, which you can find on the website. And we have been looking at projects we can use to actually reduce emissions. We're down about 14% on our emissions intensity with what we've done in 23. And we even have another project coming on in Q1 next year. It's actually going to use a bunch of actually waste gas to actually generate power. So it'll reduce our diesel usage, saves money, lowers OPEX, while at the same time reducing emissions. One of the other points we like to make is I noted the quality of the Thai staff. Our organization is almost fully a Thai organization. We have just about 200 people in Thailand in the office and maybe about 500 offshore. About 95% of those in the office are local staff. Very good experienced people who've kind of, educated in country and overseas and work for majors as well, like Chevron. So looking at what we've kind of got coming up in near-term catalysts, we have just done the corporate restructuring. We've implemented the share buyback. A couple of the key information that's coming up corporately is right in the first week of 2025, we'll likely come out with what was our cash position, because we see we're very strong now in cash generation. But importantly, we see in the middle of Q1 is getting that reserve date out to people. And then our results come out at the end of Q4. Technically, the rig is working for us full time, but it's currently on Menora, and then it'll go back to do some more drilling at the Jasmine field. But we're really working on this Wassana redevelopment and targeting a final investment decision for that about the end of Q1 in 2025. So a lot going on, but we still see good news flow coming over the next few months as we get into 2021. And so just a final touch I wanted to make on really where are we trading, because we've gone up significantly in the past 2 years, from about 50 cents up to just over $5 now Canadian. If you look at our 20 company peer group, which you can find on the web, international companies operate, whether they're Toronto, Australia, or London listed, we were the top performer in 2022. We continue to be the top performer in 2023, and we're still the top performer in 2024. However, when you look at how we trade on the metrics relative to them, we're still at a significant discount to the trading metrics. So where we currently trade at about 5.30, when you look at where the analysts have us, is looking at just under $10 there, and that's about equivalent to our NAV worked up by the reserve auditor as well. But what that doesn't take into account is looking at further reserve additions that are coming in Q1, and that's really we see the ability to take this price up, to $10 and beyond as we prove up more reserves there and get into more of a trading range of our peers. So I know a lot of people, when they look at it, say the amazing deals we did and are looking for when are we going to do the next deal. But we can add a lot of value in the company just based on the situation we have now with these 4 assets, the cash flow they're delivering, and the reserve additions that we're adding to them every year. So we see a really bright future there. So really at this point in time, just to emphasize, we've had strong operational performance, which is allowing us to deliver the cash flows now, but also into the future, and really looking out to about 2030 from these fields. We're seeing that strong reserve addition. These fields aren't ending in the next couple of years. They're going to be producing well into 2030, and further M&A opportunities. Now, when we look at it then, just looking at the metrics, we still see it's a good time to come in. And I know it's challenging for people because they kind of look at the large increase in share price and the number of institutions I've met with over the past 2 years who said, oh, with the increase, I've missed it. But as we're trying to point out, we still see lots more upside there. So at that point in time, I'll say thank you to everyone for joining us, and we'll look to take questions. Okay. The first question I've got is, we noted the Ratri prospect. Any more information, greater detail on that, cost to drill it, when it could come into production, and that how large could it be? Comments there. So Ratri was in the same block as Jasmine. It's an area that hasn't been drilled. So we're looking at going to drill that in Q1 next year. And, the mean success case on that is about 20 million barrels. It does have real exploration risk on it. But one of the important things we like to note is that our exploration wells, even though we're talking offshore here, we're probably talking that well 3 to maybe 3.5 million if we're successful and need extra evaluation on the well. So it's very low cost, and especially in a block where we're actually producing, you get back half of that, with your tax benefit at the end of the year. So the net cost to us for an offshore exploration well is about 1.5 to 1.75 million. So that's a bit on Ratri. Again, if it is successful, it's likely not only that it opens up that field itself, but then you look to expand out over time, just as it happened with Jasmine. Okay. Next question on M&A. Please discuss whether management still has a goal of 100,000 barrels a day by 2026. Actually, I think we said by the end of 26. But yeah, no, we still do put that target out there. And I know some people feel that's crazy, but I can tell you in 2020 and 21, we told people we'd be producing 20,000 barrels a day by 24, and we've actually exceeded that. There are deals of the size out there that we can do that, and we remain focused on looking at those big deals. We may do smaller ones along the way that have value and you have to take on synergies of our team, but we do see larger deals out there. And with our cash flow in that, we can actually do a deal of very substantial size. Could you comment on whether the buyback plan has been implemented, and given the current share price, if any shares have already been repurchased? What I can say is, yeah, it was valid as of November 14th, and it will run for 365 days, so for 1 year. And we are looking at the share price, and I don't know if there's been a public announcement on it yet, but yes, we have a strategy, and we do see some share repurchases would be in the plan. Could you comment on the status of the drilling campaign at Jasmine and what the October 31st status of wells as published in the ministry? Oh, okay. Related to Jasmine. So first off, we would expect to be doing an announcement on that very shortly. Some people do go to the government website, which is the DMF website in Turkey, and at the end of each month, they talk about the status of wells, and one of the wells was noted as suspended, one of the ones we are currently drilling. All it means is at this time that actually they weren't active on it at the end of the month, but it was suspended and then ready for completion. So it doesn't mean there was anything negative there. Comment, nice presentation regarding your reserves. Is your 580 million in 2P reserve amount inclusive of the 156 in cash? Yes, that was true. So it was actually based on, I think, our cash. That was all done as of year-end 2023. So it wasn't 156 at that time. I think it might have been 110 million. It was included with the actual NAV of the assets from the reserve auditor. Question, as you use NCIB, how often would you be reporting to the market on the buybacks? Actually, I'll have to confirm that, and watch this space is what I'll say. I'll follow up with the guys and get back on that. We've got a question on, can you expect reserve additions of 200% in 2023? Look, we've done a lot of significant work in-house. We've been working with our reserve auditor, putting quite a bit of work into that. We're quite confident we're going to be over 100%. And we'll just have to see really where we get to. 200% would be really good. Also seeing as we've also increased production this year, so it's even harder to continue to meet that. But we're just quite excited by the work of the team, the learnings they've had, as they kind of look at how these fields produce into later life. There's really a lot more data that we can now apply to really justify the life of these fields. And that's a lot of the work going on with the reserve auditor. Yeah, and again, there was a question on the CapEx for the new processing facility at Wassana. And look, we'll come up with guidance. We still expect to do it when we kind of do our operations update, that first or second week of January. We'll have some guidance on CapEx there, but we'll probably have firmer estimates on that as we get to the end of Q1. So we don't have anything to say on that at this time. So I think that's all the questions I have. So I'd like to thank everyone for joining us here today. And again, if you have any further questions, please feel free to reach out to us at the IR department, and you can find that in our corporate presentation that's online.